Ooh, there are no tricks, only treats. This is the Issues Watch podcast. Hello and welcome to the Issues Watch podcast. I'm Brad Muniz, your host for the bi-weekly accounting and auditing episodes. I'm an assurance principal at Clifton Larson Allen. This episode qualifies for Nano CPE credit. If you're interested in earning CPE credit for this episode, hit the pause button now and head over to njcpa.org/nano to find out how. A quick disclaimer, the views and statements expressed herein are my own and not necessarily those of the NJCPA or CLA. Okay, so we have two topics that we're covering today, or two areas that we're covering today, PCC and the PCAOB. Sticking with the PCB reference. So, well, they may not be tricks or treats. Some of the stuff is a little bit scary in that I'll be talking about today. That's more towards the PCAOB end. Actually, the treat that we're going to be talking about is on the PCC end. So, PCC, I keep saying that phrase, PCC. Now, if you've attended some recent seminars that Frank and I have presented on, you know that we've talked about PCC, the Private Company Council. What is the Private Company Council? Well, if you haven't heard us say it before, I'm going to say it again now. Private Company Council, I'm going to read off of a site that I've found. A 12-member advisory body to the FASB, the Financial Accounting Standards Board, on private company accounting matters. So they give advice to the FASB on private company matters. Now, again, if I said that if you've attended recent seminars that Frank and I have spoken on, we actually went over some of the difference between the PCC, what they've issued, and what normal GAAP is, because they've actually issued some guidance on particular areas. Goodwill, actually leases, and some other various areas. Not a lot. I wish they would dive more, but we'll keep going. The PCC advises the FASB on how to account for private companies and on possible alternatives to generally accepted accounting principles. I don't like the word alternatives to generally accepted accounting principles because that almost makes it sound like OCBOA, other comprehensive basis. But alternatives, I would say, within generally accepted accounting principles. The PCC's goal is to make accounting and reporting requirements more manageable for mid-market businesses and startups. Now, here's one of the criticisms that's come out about this. It creates a potential, or it creates the big gap, little gap mindset. And, for many years, a lot of us older practitioners have heard you can't have big gap and little gap. Well, guess what? They've come out with a concept that some people would think mirrors a big gap and little gap. So, again, Frank and I have gone over the many differences. We can cover that under another episode, or you could check for some sessions that we've done or where we have done. But they've come out with their top 4 priorities. PCCs, their top 4 priorities of where they're going to be focusing on. These are the treats that I found very interesting. The first one is credit losses. I'm going to read the 4 and then I'll tell a little bit about it. Credit losses. Second is debt modification and extinguishment. Then presentation of conditional retainage over billings as contract assets and liabilities. And finally, lease accounting simplification. So that's really interesting, really good and really interesting that these are the 4 topics that they're focusing on. I think there's some others, but these are really good 4 topics that I hope they keep pushing a little bit more on, because now I'm talking to more private companies and private company accountants, auditors, trying to deal with some of the GAAP requirements that came out from 606, 326 with credit losses, 842 with leases, and trying to apply it to some private company aspects just is very difficult. And some people say, well, it doesn't matter. GAAP is GAAP. Things sometimes have to be difficult, but is it warranted? Are the stakeholders, the users of financials, really going to be getting anything out of what we're putting in place because of this? Again, these comments are my own, not necessarily those of CLA or the NJCPA. So let's talk about a couple comments that were made as it relates to credit losses. First, the good thing is since this came out, there are four top priorities. The FASB actually said that they're going to start looking into some changes to accounting for credit losses. Remember, CECL, current expected credit losses, accounting for credit losses as it relates to private companies. So they actually have it on their calendar now, the FASB itself. But what's interesting, I'm going to read you some of the comments as it relates to each of the areas. So for credit losses, PCC members discuss ongoing annual costs of applying this guidance because private company stakeholders have told the PCC that the effect of adopting the aspects of 326 on the financial statements is not material. Pretty much when you're talking about most private companies, current expected credit losses, the area impacts is accounts receivable. How significant is the allowance for doubtful accounts? It all depends on the type of company, but when you just put this overarching requirement across all the companies, the cost was just amounted to nothing. We did a lot of work that said had no effect, unfortunately. So moving on, debt modification and extinguishment. Now, if you know, as it relates to debt modification and extinguishment, if there's so much change to the characteristics of the debt modification, it becomes a new debt. I really summarize that a lot. But of course, the private company stakeholders have told the PCC that applying this guidance can be costly and complex, and that the different financial reporting outcomes from applying it may not provide financial statement users with the information that they can use to make decisions. That's the whole thing we've been saying for the longest time. What do the readers of the financial statements look for, and what are they making their decisions? Now, most of the users of a lot of the users of financial statements are the debt holders. And if they modify the debt, they know about the modification, but when you create this whole concept of change of the debt and how it has to be recorded, it confuses the situation. It's almost like I had a client that took out $20 million of debt on December 31st, and we had debt issuance costs, and we had to show the debt net of debt issuance costs, and the banker said, "Why are you showing less than $20 million owed to us?" I said, "Oh, that's funny, you should say that, because GAAP says we have to offset the debt issuance costs against the debt." So the debt holders didn't even understand that situation. This is how you make things confusing that the readers don't get benefit for what you're trying to do. Anyway, my comments. Presentations of conditional retainage and overbillings as contract assets and liabilities. Now, you remember, they came up with 606, revenue recognition, to say we want all revenue recognition to be treated the same. There's too many differences all over the place. And then what did they do? They came out with 10, 12 different guides on how to apply it to different industries, bringing us right back to almost right back to pre-606. So you know, when you have construction companies, it can be quite onerous. It was onerous before 606. It became more onerous because they're trying to merge 606 into their current accounting practices or modify their current accounting practices. Again, private company financial statement users have told the PCC that the current balance sheet presentation guidance does not provide information that is useful for making related decisions and is not keeping with industry, with how the industry evaluates the financial position. That's the whole importance of the financial statements and the users. What are they looking for? And finally, lease modifications. They're going to go further and look into things. The one thing I hope they would look for, every boy can hope for something. Everybody can hope for a pony. But I wish they would say we're going to scope out related party leases, because it is crazy to have a related party lease in here, because a related party can change their debt. The related party change that, and thereby change the lease requirement. No non-related party would have that. So now you're going to have an accounting effect because an outside entity went and changed some arrangement that they have. So those are the big areas. I thought that they were good. Those are some treats that they're working on. Finally, they're starting to listen a little bit to this. The other one that's a little bit scary, spooky, is the PCAOB. And the reason why I say spooky, you hear Frank and I say all the time, whatever happens over here, I mean, I know there's a lot of people on here that are not affected by the PCAOB, but you're not affected right now until it trickles down to the AICPA, to the GAO, to other areas. because that's what happens. They see what the PCAOB is doing, and GO sees what PCAOB is doing too, and they say, maybe that's something we should focus on as it relates to the private companies. So in their observations from the team's 2023 inspection report, they came out with a really good inspection report. It's online. You can get a copy of it. There's good information in general. Don't think about it as a public company aspect. Look at it as an auditing of any company. But they gave the inspection results, some observations, and some good practices. I found it very interesting. They say good practices, not best practices. But anyway, I find very little things humorous. So the three areas that they focus on in this report, at least, were crypto assets, multiple jurisdiction, multiple location audits, and significant unusual transactions. I'm going to just give you a couple of the inspection results for each of the areas. Remember that there's observations and good practices that you should look at when you're reading this. For the crypto assets, auditor's response to risk of material misstatement, auditor's audit of internal control of financial reporting, audit evidence, and auditor independence. Those are the areas that they focus on, that they saw. Multiple jurisdictions. There were deficiencies in reporting on the AP forms. I will tell you from stories, at least two stories, one I know and one I've heard, those AP forms are very, very important. If you're doing public company work, those AP forms are critical, okay? If you do them wrong, they could be considered not complying with PCAOB rules and regulations. So for those people who are like, I'm just filling out a form online, it's like a survey. No, they're very, very important. Okay, miscalculation of the percentage of participation of other firms. I know a firm that used somebody overseas, and the PCAOB criticized them because the percent they put in was too small. And I'm not talking, oh, it was 100% versus 1%. No, I'm talking like points of percents. And finally, significant unusual events or transactions. Again, identification and response to the risk of material misstatement. That's where the issue, one big issue is. And two other areas I'll say real fast. Firm personnel having the requisite skills and experience involved in auditing such area. And finally, your internal compliance with required consultation. Those are areas, the three topics and the areas where they found issues. Okay, that was a lot for me to cram in. So in closing, here are some upcoming accounting and auditing events. There's an Auditing Standards Update webinar with Renee Rampula on November 1st. There's a free webinar on November 4th on digital fraud and scams. And the Hudson chapter is holding an in-person A&A update on November 12th in Sea Caucus. Get info for these events and more at njcpa.org/events. And of course, be sure to join the Society's Accounting Audit Standards Interest Group. Sign up for free at njcpa.org/groups. Thank you for watching or listening, and I'm hoping that these arms didn't scare you.